Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go over the thesis of the channel. The thesis of the channel is we're going to be entering an inflationary environment with higher interest rates based off of demographics and a expansion phase of real estate. And it's a mouthful, right? We have the millennials coming into home buying years. It is a larger demographic than Gen X. It's also a larger demographic than the baby boomers. This larger demographic is going to put pressure on house prices to increase quite dramatically. We've seen this already, and what I'm proposing is that we're going to have to build a bunch of new homes. When we build these new homes, it is inflationary. The majority of money in a fractional reserve lending system comes from commercial bank lending. And over 60% of commercial bank lending comes from residential real estate. When we've entered these periods before, it has always been inflationary. It's increased the money supply. And so what I'm proposing is that the floodgates in the commercial banks are open, and they're going to be loaning into existence against new homes, which are new assets, which increase the money supply, the M2 money supply. So that is the conditions that are coming, and that will ultimately increase interest rates because of the inflation. Now, if we look at history and we look at the 1970s and how we had an increasing interest rate environment, that's what we have up here. I'll talk about all this right here. And this is your 10-year interest rate treasury bond. We had this gigantic increasing interest rate environment. And what I'm proposing is that it was driven by the real estate boom and demographics. Between the baby boomers and the millennials is Gen X. Gen X is a smaller cohort of people, and that smaller demographic it basically let the air out of the balloon. It didn't have enough people to sustain a highly inflationary environment. So we have this huge bear market in interest rates going down. And what I'm proposing is that we're entering a new bull market or higher interest rate environment coming up. And that you're very early to this game, and the investment opportunities here can be absolutely stunning. And I'm going to get into the environment and some of the investments here. This is the new privately owned housing unit starts. What this is single-family residential. The line going across here is the average. And this is just the housing unit starts per year going up and down, or per month going up and down, which is basically the real estate cycle plotted over time. Whenever you go above this average dramatically, like in the 1970s, you're going to have a inflationary environment. And it was followed by a deflationary bust behind it. Or I should say a recession in housing, which equaled some recessions in the overall market. And one thing I wanted to touch on was all it is, the boom is just a leveraging up, a bust is a deleveraging on the backside. I wish I had known this when I was a kid. That's what caused the depression. It's these boom bust cycles. And we had a massive bust in the mid-2000s. The mid-2000s, we had basically a fake housing boom because of loosening lending standards. And what happened is we created a bunch of foreclosures. Those foreclosures screwed up the housing market, the real estate market. And if you notice here, we'll jump back in, this area under the curve in the yellow here is how many homes that we didn't build because this was all messed up. We were in a housing hypersupply phase up here. We also had a bunch of mortgages that were not legit mortgages. They were given out, and these people could never afford these homes. What happened was all the foreclosures went onto the market, and the housing builds couldn't compete with those foreclosures. So they didn't build as many new homes. What that created is probably the largest investment opportunity that I've ever seen in my life. And the reason it creates that is because we are now in an underbuilt scenario where we're short a whole bunch of homes and a larger demographic is coming into home buying years. And what that is, it says the housing shortage is worse than ever and will take a decade of record construction to fix, new report says. That was June 16th, 2021. To make up the shortage, the NAR report says that U.S. would have to build 2.1 million homes each year for a decade, more than it built each year during the housing boom of the mid-2000s. This was the mid-2000s boom. This was a small inflationary environment. The large inflationary environment in the 70s was this guy over here. What they're proposing is where this green line roughly is. That's 2.1 million. And that we have to go into this massive expansionary phase of real estate and stay up there for a decade. That is going to be the largest real estate boom that we've ever had in America. And why that matters is that all commodities and all these things are priced in dollars. And what this is telling us is that we are going to go into the largest inflationary expansion phase of real estate that America's ever seen if we were to build all these homes. I've got these green circles here, and what those are indications of is the commodity to S&P 500 ratio. When the ratio is low, and that's what these green circles are down here, you want to buy commodities because they're cheap in relationship to other assets. When it's red, they become expensive, and you want to sell commodities because they are expensive in comparison compared to other assets. These green circles I overlaid over the housing starts to show you the correlation between the two. Whenever this thing went and put in a buy signal of commodities, you always wanted to buy it if the market conditions aligned well with the expansion phase of real estate. Buy point 1, buy point 2, buy point 3, and by point 3, we're going into an expansion phase of real estate with the most underbuilt scenario in history for homes. So what I'm proposing is that this could potentially be, and if you look here, we're also the cheapest commodities have ever been in relationship to stocks. We're down here, coming back up, and I'll show you some real-time charts right here. We've never been this cheap in terms of evaluation. So there's a twofold thing here. We've never been this cheap in terms of valuations, and we've never been this underbuilt in terms of real estate. So this setup is like, no one will ever see this again in their life because we messed up the real estate market so bad and came into this underbuilt scenario. The demographic coming up is larger, and we've never been at valuations this cheap. This is perfect, guys. This is insane. So here is the commodity to S&P 500 ratio, looking at it real time, 2020, 2021. We've broken the downtrend line just recently, and we're coming sideways here. This is the time, in my opinion, to get ultra bullish. This is where you want to start investing and allocating money to the commodities index, and that's just my opinion. It's not financial advice. Now, zooming in on that end, this is what the zoomed in portion looks like on the end, and we just broke out of this pattern again to the upside. Doesn't mean that we'll just rally up. We may backtest or retest a little bit, or move sideways a little bit higher, or maybe we just take off. But right now, this thing looks fantastic on any time scale that you want to put. Now, I'm looking at, this is another chart that a lot of people on the channel haven't seen. This is the oil to SPX. This is oil to stock ratio. And what we're looking here is we're looking at a downtrend of oil, and that we're about to break to the upside of this downtrend line very, very soon, and probably see fireworks happen because oil is the biggest inflation hedge. And if we're coming into an environment where we're going to have lots of inflation and real estate is the driver of that, and it could last for 5 to 10 years, oil is going to be an absolutely incredible investment, especially when it's coming from the lowest valuations it has ever seen in history. So you can buy an asset that's the lowest it's ever been in relationship to other assets at a time when we're going to see the most inflationary period come in front of us. Here is the uranium market. I put the market has shifted into a sustained deficit. This is a graph that I grabbed. We have a massive deficit coming right in front of us. It is coming, and this will compress its uranium to gold or gold to uranium ratio. This is the supply-demand imbalance, signaling that not only are these things going to move up for an inflationary environment, they're also going to have supply-demand imbalances, which will compress the ratio against gold quite dramatically. Here's the long-term copper to supply-demand, and you can see that the supply here, you're going to get a large imbalance of demand versus supply over the years. So it's more evidence saying that we're coming into a commodity, probably super cycle. This is the nickel chart. So again, nickel inventory overhang is going to be worked off somewhere around 2023, where new supply is needed. We don't have those projects to do that, and the gap becomes quite substantial moving forward. So nickel would be another good investment opportunity given the market conditions, valuations, and the market supply-demand deficits that could potentially hit in nickel. I also did some calculations on leverage. So looking at this chart here, the uranium price projections, this is the ratio, and when you compress the ratio, the price can go up vertically the more you compress it. If we are in a ultra bull market uranium over these years, in an inflationary environment, I am proposing that the best investment with the most leverage in any commodity would most likely be uranium. This is what I calculated when you compress it up given different gold valuations. If we get to a $10,000 gold valuation when uranium compresses, which is somewhat expensive, we could compress all the way up and be at $2,000 or $3,000 uranium prices if gold is at that price. If gold doesn't go up much and we're at 2,000, it only go up to a few $100s. If gold goes to 5,000, we would compress up and we get to 1-to-5 ratio. It could potentially be $1,000 a pound. I don't know where it's going to end up. I don't know how much uranium is going to compress against gold. This is just a chart showing you what the compression could look like and how much leverage you can get. Looking at some other ones, these are oil price projections, which also have massive leverage to the price of gold. So I would say that oil is another good investment for this type of environment with very good leverage. Another one that has very good leverage when looking at it is natural gas, and these kind of come in a package together. Natural gas has massive, if you look, compression if these prices were to compress up. So I would say that those three, natural gas, oil, and uranium, are some of the best investments that you can make in a commodity bull market. Now, looking at some of these other ones, here's the platinum price projection, which shows leverage to gold. This is the compression of the ratio to gold. And we also have very good leverage here. And keep in mind that these leverages will lever to it at different times. Uranium and oil make their moves earlier in the cycle, so gold will be at a lower price. So if we were to make a projection here, let's say gold is like 5,000 or between 2,000 and 5,000 and it compresses down here, oil could be $500 a barrel. So coming from where we are today, it would go from like $70 to $500. Now, platinum, if gold were to peak at like say 15,000, platinum compresses against it, platinum could be $45,000 an ounce. That's the compression if it were to do that and gold were to go to 15,000. If it goes to 10,000, you could see platinum at 30,000. So And that's if it were to compress the entire way. It could also compress to 2 and be at $20,000. I know it sounds like a lot of money, but if platinum compresses and we get a large boom, we could see some ridiculous numbers depending on the supply-demand balances. I don't know if it's going to get there. These are not price projections. They are just throwing out numbers given history and how things are compressing against each other. And these could be very low. I'm not exactly sure where all this stuff's going to end up. Now, here's a chart of the oil price. And there was 2 major resistance areas, around $60 and another one around right where kind of above where we're at today. If we break this and close at, say, $80 a barrel, we could see a massive move up because there just isn't much resistance up here. So that's one to watch because we're getting close to some of these breakout points where I think a huge move could potentially be coming. And then we also have uranium. Uranium's been compressing quite dramatically ratio-wise and also price moving up recently. So another one to look at would be uranium. It is still incredibly cheap, and I think that this ratio could compress far higher. Not the ratio, the price could go far higher than what most people think. Another thing I want to touch on here with uranium is new supply can't come on very quick. Even if you have a mine on care and maintenance, it may take a year and a half to bring it online. That means that if price moves on up and people want supply now, it's not going to be available. So if price is the limiting factor, and let's say it may take 4, 5, 6 years for enough to really come on to satisfy demand, I don't know what that means for price. There's going to be a massive squeeze, and it's going to be a squeeze for a long time. So I think that's a huge, huge opportunity for investment is uranium over the long term. Now here is the demographics here. I kind of put in the black square here the home buying demographic. If you look before it, this demographic is much less, the Gen X demographic. And then we have the baby boomers, which are here. So we've got the baby boomers here. We've got the Gen X, which is a lot smaller. And then we have this large kind of boom in the millennials. So the millennials are going to be, they're coming into home buying years. This is the age 32 to 34. 34 is the average age. And you can see right behind it that we have this huge, gigantic area of more demographics coming through, more people. So I propose that we are going to have to build a lot more new homes for this demographic. It's going to be inflationary. And the last slide I have here is the gold to monetary base ratio. And what this ratio is telling us is that gold has not accounted for the monetary base, which means gold has a huge upside potential to account for how much money is in the system. Gold only accounts for the monetary base under inflationary conditions. The 1970s here, this was from 1999 to 2008. That's what this move is here. And then we have a move here, which I think will potentially be coming and have a gigantic revaluation, potentially all the way up to 3.5. We could go up 6, 7 times in gold or 8 times in gold. And that's the average that gold goes up during a bull market is 8 times. So we could see $8,000, $10,000 gold very easily, and it would be just a repeat in history. We could see it go to $10,000 or $20,000 gold. If it goes to those levels, oil and uranium and all these other commodities are going to go crazy to the upside. And I know that seems hard to figure out. What I'm saying is we're going into an inflationary environment because all of these charts are putting in bottoming patterns. The likelihood of all of them putting in a bottoming pattern all at the same time, it's like 0 if this is wrong. I just don't see it. You could have a chart or two, but everything, all of our charts, all of our data that we have, the expansion phase of real estate and how all this aligns with it, I'm pretty sure, I think this is a pretty well thought out thesis that I think will potentially happen and play out. There are other measurements that you can look at. You could look at the price producer index in relationship to the CPI. I saw some other people using that. It looks pretty promising from that perspective. That producer price index is outpacing the consumer price index, which means that eventually inflation is going to hit CPI numbers. And we're seeing that right now. So when this all unwinds that I just described here, when we get that inflation, we have higher interest rates and money starts to rotate into commodities, commodities are going to go up substantially. I mean substantially. Life-changing, life-altering investments are the potential here. When looking at the math, the best potential commodities, in my opinion, for investment opportunities would be physical platinum. Physical silver would be good too, but physical platinum is the one I really like. Physical silver. If you look at some of the ratios of the gold miners in relationship to gold itself, I think some of the mining companies could be very good. I like to play it with the royalty companies, so I like a lot of royalty companies. Copper looks very good. Nickel looks good. Tin looks good. Rare earth metals looks like a potential investment. I think all of the energy sector historically has been the best performers in commodity bull markets. That would be oil, natural gas, and uranium. So any of these areas, I think, are very good investments. I also think real estate and home builders are good investments as well. You could probably throw darts at any of these sectors and make a bunch of money over the next 5, 10, 15-year period. That's about how long I would say this bull market in commodities is probably going to last. And it could even last longer than that, depending on what sector it is. We also have sprinkled in this mix a renewable electric vehicle boom, which is going to stress commodities even further. If we go into a hydrogen economy, that could also put even more stress. It would stress some of the materials would be nickel, copper, silver, platinum. A lot of these base metals are going to get stressed. And I think it's coming. And I think it's going to be the largest investment opportunity of anyone's life because of the low valuations against commodities, against any other asset you want to measure by, and the inflationary period that could potentially come from a gigantic expansion phase of real estate. So that is the data. This channel talks a lot about all of these things, about specific companies in some of these sectors. It talks about the thesis here and how we monitor the real estate market to ensure that we're right. I look at technical analysis of individual companies in a lot of these sectors to get investment ideas, and that's what we look at. And we continually monitor. I use it for buy points. What I do is I buy, I hold on as long as the valuations are good. I do not trade in and out. I do not worry necessarily about my investments. I have another job, so I work that job, and that's what I do during the day. So I don't trade in and out. I don't do that stuff. I buy it when it's cheap. I hold on, and I'll sell when it gets expensive, when it becomes overvalued, the ratios. And that's what we look at and monitor on this channel. If that's something that interests you, click subscribe to the channel. Give me a thumbs up for this content. And thank you for listening. This is Finding Value.